Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. I am going to talk to Mr. Noah Rosenfarb today. He's a well-acclaimed CPA, investor, and a syndicator. So welcome, Noah.
Thanks for having me. Pleasure to be here.
Absolutely. You know, I have been following Noah on LinkedIn for a while. He put some interesting posts about taxes. And as soon as someone starts talking about tax benefits, my eyes lit up. I'm like, I got to know this. I don't know why, but I don't want to pay, most of my money to Uncle Sam. I want to keep most of what I make.
Yeah.
So Noah, tell us something interesting or funny about yourself.
So I'm a third generation CPA, and that's quite uncommon, even though my family immigrated here like so many other American families. Yeah. But my grandfather, he was a CPA, and then he ended up having a meat distribution business. And my dad was a CPA, and he had a CPA firm, a traditional CPA firm, and I ended up joining his firm. And coincidentally, I married a woman whose dad is a CPA as well.
Oh no! So you only talk about numbers on the dinner table, right?
Right. Exactly. Yeah. So there's a reason I'm passionate about tax planning.
Oh, I can tell it's in your genes.
Yep.
So, do you invest in real estate yourself?
Oh yeah, I got started when I was 22. My wife and I bought our first two-family house. I house hacked that particular purchase. So I bought it from the builder. Builder had lived in the house for 2 years, so he could avoid the cap gains tax when he sold it. And so when I bought it from him, the asking price was $225. And I said, listen, I'll pay you full price, but I'm actually going to pay you $232. I'm going to pay you $7,000 more than you're asking if you give me a $7,000 closing credit. So he said, of course, why not? What do I care? And when we got to the closing table, that was my down payment money was $6,960, and I got $40 back at the closing. So,
whoa! That 22 years old. Wow, that's crazy.
So house hacked my first deal with my wife. We've been buying property ever since, and now we own about 4,000 units along with investors. We don't own it 100%.
That's nice. So why did you start investing in real estate? Like at 22, of course, did someone tell you about it, or was it just...
My dad, as a practicing accountant, I knew who his wealthiest clients were, because sometimes there was dinner table conversation, and he'd talk about this guy and how he had this apartment building and that guy who had this apartment building. And so, my own reading, I read Rich Dad, Poor Dad when it first came out. I loved that book, and just decided, what, my plan when I was 22 and I joined my dad's accounting firm, I said, I'll have a nice solid job. My wife was a school teacher. We'll make a good income, and I'll take my savings. I'll go buy two-family houses. I'll get to 20 units. And by the time 30 years comes around, I'll have paid down the mortgages and I'll live off the rent. And that was my thought of a sophisticated retirement plan. And as time marched on, I started to realize that owning them directly, owning these 2 and 3 family, 4 family houses, it really wasn't for me. It wasn't my best talent.
I agree. Yeah, because someone like you who has solid CPA and accounting experience, you got to go bigger, right? No, that's awesome. So, and I want to talk to someone who themselves, CPAs who themselves invest in real estate. So, of course, I have spoke about the tax benefits like almost every time, but can you please take us through why real estate investing is so beneficial?
So the government has tax incentives, and every time that they write these IRS codes, it's because they want us as taxpayers to do certain things. And one of the things that we're very familiar with is we could deduct our mortgage interest when we buy a home that we live in. And now the government's incentivizing us to buy a home because they want Americans to own homes. At one point in time, home ownership was up at 65%. Now it's a little bit lower, but still around 60%. But that's one of the reasons home ownership is so popular, is there's a tax incentive. Right. And the same is true with buying apartment buildings or buying an office building or buying a retail shopping center. The government is basically saying, hey, we want you to buy these assets. And one of the ways we'll incentivize you is by allowing you to deduct a percentage of the purchase price every year against your income. income. So you could basically get some income from real estate and not pay any income tax. And it's a beautiful thing.
Oh, that's a great thing. This is why I got started in real estate. And now I would say 60 to 70% of my portfolio is in investments where I got to have two things, which I talk about all the time: cash flow and tax benefits. If I don't see those, then I'm not going to invest. Yes, I have speculative money in my cryptos, but that's a whole different world.
Yep. No, I mean, I started investing for cash flow a long time ago, and I just found that I miss out on certain investment opportunities where you can double, triple, 10x your money in a short time frame. But that's okay. I'm fine. I like hitting singles and doubles all day long. That's really my bread and butter.
Yeah, as long as I get 10 grand a year from a property and I'm not paying any tax on it, there is a negative K1 of 20 grand, and I'm fine with that.
Exactly. Yep. I just had one of my best K1s, negative 328% of our initial investment. Yeah, really powerful.
And I don't want to throw a curveball at you, but this is one of the things I ask my CPA as well. And a lot of my investors ask me that we are not able to take advantage of that depreciation because because most of us make more 150 grand. And then we are not real estate professionals, REPs. So have you figured out any other ways that an investor can take advantage of those depreciation?
Well, I think one of the things you want to look at if you're going to put a lot of your capital into real estate is if you can't be a real estate professional and you're married, could your spouse be a real estate professional? And if you can get your spouse to qualify, now remember there's a 5-pronged test.
Yes.
The two hardest parts of the tests are it has to be a minimum of 750 hours working on real estate. And it also has to be the thing that you do more than anything else. So if you could have your spouse meet those two criteria, then let's pop all the ownership of real estate into their name. Now, again, this wouldn't help if it's a limited partnership interest, but if you're going around collecting 2-family houses or you're doing an Airbnb strategy, hey, this will work. Or if you are a syndicator and you're part of the general partnership, this would work for you as well. So this particular year, I mentioned I got this amazing K1 with negative 328% in losses. I was able to convert 100% of my Roth, my 401k and my IRA to Roth this year, in part because I had all of these losses from all the real estate deals that I did, and that was offsetting all my ordinary income. So I did the Roth conversions, and now I'll never pay tax on my retirement money again.
That's crazy. That's crazy. So another question I have is that let's say I invested in a syndication last year, and I received a negative K1 of 50 grand. But the same last year, and actually this is a true story I'm talking to, I had a capital gain because I sold a property and had capital gain of about 40 grand. Would that 40 grand be offset by the 50 grand of passive income loss?
Yeah, exactly. So you'll pay no tax on that capital gain. It's another beauty of real estate investing. Even if you're passive and you have these LP interests and you're not taking advantage of the depreciation losses that are getting passed through to you, eventually one of the partners in your partnership is going to sell and you're going to get a K1 with a big gain. But if you have these losses that have been accumulated, you'll pay no taxes on your gains either. So no tax on the cash flow, no tax on the gains. It's a pretty good racket.
No, that's awesome. And let's talk about why I have you here, especially Puerto Rico, because I've been listening about Puerto Rico I would say for last 3 to 4 years. And of course, a lot of people moved there, a lot of big names, Peter Schiff, to lots of other names. Why do people move to Puerto Rico to save taxes? Save on taxes.
So in 2012, the island of Puerto Rico, which has its own tax system. So the residents of Puerto Rico are US citizens, but they don't get to vote in American elections for president.
Correct.
They don't have all the same rights as US citizens that are based in the mainland, but they are governed by their own tax system. So if you live on the island of Puerto Rico, you pay Puerto Rico taxes, not US taxes, not Florida, California, Texas, Arizona. There's no state tax.
Don't talk about California. I'm sorry to interrupt. Don't talk about my state. It's the worst.
So Puerto Rico, interestingly, a little bit of the origin story is kind of cute. So I think it was around 1986. Puerto Rico installed some incentives for manufacturing. And as a result, we had a really large volume of American drug makers base their operations in Puerto Rico. And they were one of the largest manufacturers of prescription medication.
Oh, okay.
They sunsetted that tax benefit. And what do you know? All the companies moved away from Puerto Rico. So Puerto Rico was like, oh, I guess that didn't work. How about we'll try and attract wealthy individuals and entrepreneurs? And so in 2012, they came out with two rules. One rule says, if you come live in our island and you become a resident in our island, you'll pay no capital gains tax, no dividend tax, no interest income tax. Wow, that's pretty amazing for an individual investor. And then they said, okay, now if you're an entrepreneur and you want to build a business on our island, we'll only charge you a 4% corporate tax rate.
That's
Again,
it.
pretty amazing.
That's it. Not 21%, which we have right now.
Right. So just 4. And then if you live on the island and you get a dividend from your Puerto Rico company, there's no tax on your dividend either. So pretty amazing, powerful tax optionality for US citizens that don't want to relocate overseas, but they are comfortable living in a Caribbean island. So those incentives came into place in 2012. They've been amended and modified over time. They used to be referred to as Act 20 and 22. Now they're combined under Act 60. And 2014, I had learned about this. I was actually very surprised. It took me 2 years to learn about it. And once I learned about it, I started going, well, wait, how am I going to figure this out? I don't want to live in Puerto Rico. I've got 2 young kids. I have a beautiful home that I built in where I live in Florida. I really like my lifestyle, but I don't like paying taxes. And so over the course of 2 years, I kept brainstorming with a couple of counterparties that were Puerto Rico tax experts. And finally, we came out with the solution. And so I was able to base my company in Puerto Rico while living in Florida and still taking advantage of those tax laws.
You are not serious. Is that even possible?
So
I don't want to move to Puerto Rico, but I do want all the tax benefits.
So I had a couple of things that were in my favor. So one is you need to source your income to Puerto Rico. So somebody has to be physically working in Puerto Rico to source this income. Now, my brother is educated as an attorney. He was looking for a change of job opportunity. And I said, you know what? If you're willing to work in Puerto Rico, I got a job for you. So he moved down to the island about 3 years ago, and it's worked out fabulously well for both of us. He lives in a 2-bedroom condo overlooking a beautiful beach right on the sand. And, you know, it's a great lifestyle for him. And for me, it's given me the opportunity to grow and scale my business with him at the helm and source our income to Puerto Rico.
That's awesome. So let's say someone like me, if someone like me wants to take advantage of something like this, I remember you mentioned about having a 401k or an IRA, which is domiciled in Puerto Rico. I'm not sure. I can't remember the entire discussion, but I want to learn more.
Yeah. So anyone can set up their business in Puerto Rico and take advantage of this corporate tax law. And if, let's just say, you decided you wanted to live in California and you wanted to own your company personally, you'd pay a 4% corporate tax rate to Puerto Rico. When that company had profits, it might issue you a dividend, and you'd pay dividend income tax, which right now is around 20% for federal income tax purposes. So you'd be all in at 24%. Well, that's a lot better than the current, tax regime potentially for you. But if you want to avoid that dividend tax, one of the ways to avoid a dividend tax is to own a company inside of a qualified retirement plan. In this case, a 401k. So if you own Google, Apple, Microsoft, Netflix, S&P 500, any of those stocks in your 401k, and they were to issue you a dividend, you'd pay no dividend income tax because it's owned by your 401k. And so I was able, with the help of some very smart people, to start my business in Puerto Rico, own it inside my Roth 401k plan. So not only when I get a dividend does it go into my 401k plan tax free, but while it's in my 401k, it compounds tax free. And when I eventually take it out, it'll be taken out tax free.
Roth, right? Roth is a huge thing. And when you mentioned about Roth as well, just last year, so recently, I also converted about 25,000 of my traditional 401k to Roth so that I can invest that in cryptos, and I don't want to look at it for 20 years.
Smart. Yep.
So I hate retirement plans, but if anyone wants to go with any retirement plan, Roth is the way to go, because I don't want to pay tax on my harvest. I would rather pay tax on the seed, right? I know,
Yep.
and I don't want to worry about it ever. So that's pretty interesting. So let's say I have a business and I want to set that up. Do I have to start another business with the same name in Puerto Rico?
Every situation somewhat unique, but every single instance you need to start a new business in Puerto Rico to use this strategy. Yeah, just because of the way all the rules work. And again, it was rather complicated. Like I mentioned, it took me a few years to figure out.
Right.
But if somebody's just starting a new business, it's actually quite simple. The tax code section that governs these types of plans is referred to as ROBS, ROBS, roll over business startup. So there's a, very well developed tax code around how to own a business inside of a 401k plan. It just took a long time for me to figure out how to apply it to my situation, how to handle the Roth conversion aspects, because I'm a US resident, Florida resident and Puerto Rico. So there's a lot of details that we had to iron through.
Got it. So once you have that business, and if you are running that business, would you not have issue with IRA because it has to be an arm's length transaction, if I'm correct? So how do you work around that?
Yeah. So in a 401k plan, you can own a business, but you have to be employed by the business. Now, if you wanted to own a business inside your IRA, you're prohibited from working in the business. So two different types of qualified plans, two totally different sets of rules. Now, for real estate investors, this is important to know that IRAs and 401ks also have another kind of unique rule that isn't the same for both plans. If you put $25,000, $50,000, $100,000 into a syndication through your IRA, you will be subject to some potential taxes called UDFI.
UDFI. Yep.
Now, if you invest through a solo 401k, now you don't have that tax. Yep. So if you're thinking about investing through your IRA, but you could potentially create a 401k plan for yourself, you're way better off investing through the 401k.
Yeah, I agree. And that's why I have solo K, and which I just had to convert to Roth as well.
Yeah.
But yeah, when I was comparing, and this is exactly what I learned 5 years ago. I was trying to, because I had SEP IRA, right?
Right.
And then I found out about self-directed IRA, and I was like, I need to move to this. So I started comparing all the IRA custodians, and then someone told me about solo 401k. So I put them side by side, and I'm like, solo is far superior and gives me direct control. Being in California, I would have to open a checkbook LLC. That's another $800 a year, right? A franchise tax. So I'm like, solo K is the winner, in every aspect. No EDFI or UBIT. Yeah, I highly recommend people, if you can run a business, definitely go with solo 401k. So in this case, then you are setting up a 401k, solo 401k plan. That's why I'm allowed to. In my case,
I have employees, so it's more than one employee. It's not a solo 401k. It's just a 401k plan.
401k.
Yeah.
Got it. And then the 401k owns the business. So in that case, the business just pays 4% tax and no other taxes have been paid.
It's pretty amazing. Yeah.
So this is awesome. So, but for Roth, we put money after tax. So how does that work in this case?
So when I set up this business, there was really not that much that I had to invest to set the business up. So I just invested $10,000 in creating my new company. The way I had to do that was take $10,000 from my rollover IRA and put it into the 401k plan. And then I used that $10,000 to buy the shares of the company. And then I did the Roth conversion. So I had to pay tax on $10,000 to convert it from traditional to Roth.
So that was the very first time. After that, you don't have to pay any tax.
That's
even
it.
on
Now,
all the dividends you
receive. If I have $1 million of income, I pay $40,000 in tax, and $960,000 goes right into my Roth 401k. There's no limit on the amount of distributions that can come from the stock that you own in a 401k. There's limits to what you can contribute to a 401k, but there's no limit to what the 401k owns could grow to.
Got it. No, this is awesome. It's like I'm so excited. Just 40 grand of taxes. That's amazing. And then being a syndicator, being a real estate investor, I know you are going to turn around and invest that money as well in investors, right? So that money is going to compound like crazy.
Yep. Well, they say if you double a penny a day for a month, it's worth, 5.2 million. But if you doubled the penny every day and the tax man came to take 30% every day, you're only left with 50,000 at the end of a month. So it's a big difference.
That's huge. Yeah. Yeah. Another, and I'm quoting the book, Tax-Free Wealth, right? The biggest expense we have is taxes, not
No
mortgage,
doubt.
not any, but it's the income tax, right? And everyone, we have been taught that, oh, put it your money in IRA and 401k. You are just kicking the can down the road. You got to pay tax on it if it's not Roth, right? So this is best of both worlds.
Well, I think the common wisdom of, which maybe is a Dave Ramsey, Susie Orman type advice is, hey, defer your tax because you're going to be in a lower bracket when you retire. And that may be true for someone who makes 100,000 a year,
Right,
150,000 a year.
exactly.
But if you have a plan to be wealthy, then you have to look at our government deficit and say, okay, we just went from 24 trillion to 30 trillion in debt. We've got all these, liabilities that are off our federal balance sheet. Do we think tax rates are going to go lower or higher on wealthy people over our lifetime? And I just know my bet is I think it's going to go higher. So I want to get rid of the tax man as my partner as soon as I can.
No, and a couple of things. And I'm going to quote someone else. I'm trying to steal your thunder here. But Robert Kiyosaki says that why would you want to retire poor? I want to I want to be as rich as I am right now, if I'm not richer,
Right.
and I'm not rich, but I want to have same income what I have right now when I retire as well, if not more, right? And if I have the same income, am I going to have the mortgage deduction? No, I would have paid off my primary house, right? So people don't think of it that way, that I'm not going to have the same deductions as I had right now. My kids would be older. They will be paying their own taxes. So I'm not going to claim any deduction on dependents. So actually, my taxable income would be more when I retire.
Right.
So I don't want to pay Uncle Sam
Me neither.
after
Right.
retiring. So no, this is awesome. I thoroughly enjoyed the discussion. Let's talk about real estate now.
Yeah.
What has been your best real estate deal so far?
Good question. I mean, I've had some great wins. I would say this deal where we had this massive depreciation is shaping up to be our biggest win. We got 90% seller financing at closing, and that's what helped us to get such a high pass-through loss. We bought 475 units in Decatur, Georgia for about $30 million. And we've done some capital improvements, but not a whole lot. And I would say it's probably worth a little bit around 40 million already. And we only had 3.5 million of equity in the deal. So, we basically quadrupled our money in 12 months. And now we're going to the bank this summer. We're going to get all of our initial capital out through a refinance. So we'll have all our money back. We'll have all these losses that we've gotten. We're going to get about a $5 million construction loan, and we're going to go rehab the property. And I think after we make those improvements, we'll be able to refinance again, get our money out a second time. And then the distributions on an annual basis will be something like 30% on our initial investment.
That's nice.
Yeah.
That would be awesome.
Huge win.
Yeah, I can tell. What kind of mistakes did you make in real estate investments when starting out? And what did you learn from them?
Yeah. So I started by, buying this 2-family house. My wife and I lived in half. We rented half. That was a new property. It was brand new when we bought it. So there wasn't a lot of maintenance. That was a great decision for us because basically our tenants were paying all the expenses and we got to live there for free. And then a couple of years later, I was able to get a line of credit, a home equity line of credit, pull out equity, go buy another property. Now that was smart. But then what happened was when I got to 7 units, I started to realize that at least one day a week and at least one day on the weekend, I was spending at least an hour, if not more, dealing with my tenant. And as a young accountant at the time, I started to do the math and say, wait a minute, if I got paid $100 an hour, which is what I would want to make if to do this work for somebody else. And I started deducting that from my cash on cash returns and looking at, well, what am I really making on my money versus what am I making on my time? All of a sudden, my returns went from mid-teens to, 5, 6, 7%. And I started saying, well, this isn't actually that good of an investment. So for me, I decided to leverage my personal network, my own business acumen. And instead of just investing my own capital in these 2-family and 3-family deals, I should sell everything and start buying big buildings with other people's money. So that was the mistake I made early on, wasn't kind of identifying where my strengths were and valuing my time and recognizing that, the cash on cash return could be misleading if you also have to put some time in to make it happen.
I agree. So as soon as I started investing, I always had a property manager. And of course, I didn't have choice because I was always investing out of state. But even when a lot of investors send me their numbers to analyze, and I'm like, where is property management expenses? They're like, oh, I'm going to manage. No. But you still got to have the expenses. Tomorrow you will get tired. Tomorrow you will say, I got to give it to property manager. And that's when you'll be screwed.
Yep. No doubt.
Oh, this is great. Let's take a quick break. And after the break, we'll go through the same questions I ask every guest.
You're listening to the Wealth Matters Podcast. The Wealth Matters Podcast. For more info about what we do, check us out at wealthmatters.com. It's wealth, WEALTH, matters, MATRS.com.
Welcome back to Wealth Matters Podcast. Noha throws a lot of golden nuggets today. And so I was very impressed about how I can set up a business in Puerto Rico and set up a solo 401k plan. So actually, I'm going to talk to him after the podcast itself. So and this is why I remind everyone to start a side hustle, some kind of business, because the amount of tax benefits you get by having a business and second, by having real estate investments are huge. So look into those. Noah, are you ready for fire round?
Can't wait for it.
That's a great advice. And that is what, Wall Streeters refer to as diversification. And that's what all of us should be doing. Even when my investors ask me that they want to put more money in this one of my deal, and I always tell them no. Like, yeah, put minimum. I know you should spread out even with me, others. And maybe if you are interested, buy a single family just to learn the ropes. All right. So that's a great advice. How do you give back?
So my wife and I like to support education, food security, and Jewish causes. So we have a donor advised fund, which is like a family foundation that we established a number of years ago. We actually just made $1 million gift to celebrate our 20th anniversary. So that was a great milestone for us to be able to, acknowledge and want to support our community that way as a result of the success that we've had. And then in business, I'm really passionate about entrepreneurship. I think entrepreneurs are the true heroes because they're the ones creating value. And so I built a business just to support them. Freedom Family Office is really focused on helping successful entrepreneurs that have like a $20 to $100 million net worth. So they're very wealthy in most circles, but they're not quite wealthy in family office circles. And we provide them with the support that they need to ensure that they could really have the life that they want. We refer to that as being rich beyond money. So our clients already have the cash. Now it's helping them build the life that they want.
That's awesome. How can my listeners reach out to you?
LinkedIn's a great place. Just find me at Noah Rosenfarb on LinkedIn. If you reach out to me on Facebook, if that's your primary platform, I might accept your request if we've got some friends in common. But if we don't, I apologize. You got to connect with me over on LinkedIn.
Thank you so much, Noah. I thoroughly enjoyed the discussion.
Nice to be here. Thanks for having me.
Thank you.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!